Okay, folks, let's get to it. This is Friday's recap. This is the day where we take a look at everything that we put into motion on Monday or maybe the week before. So let's get started with, let's take a look at the snapshot for the winning trades that we've closed out. So there's no losing trades because we had none. So we had two this week. We've got those highlighted. The first trade we closed out was an iron condor with the SPX in my IRA. It's real money. And we held the thing for 10 days where we hit gross profit was $15.95. I thought it was a little bit higher yesterday, but when everything settled up, it was $15.95. Plus the commissions and everything to get out of that, we were ended up with $15.71. So my play right now is to tranche in. I was hoping to get a down move. We did a little bit. I got a little bit of a down move today in the SPX. You know, but I got to admit, 7 points down in the SPX in this environment's like 50 points down in a normal market. So I'll be looking Tuesday to put on a tranche in with first tranche of my iron condor for the next 45-day cycle. So anyway, we closed this one out for $15.71 in profits. The second trade we closed out was the strangle in the S&P 500 in the futures market. It's my personal account, real trade, 3 October to 7 October, 4 days, 21,000 in buying power, and 525 in profits. It expired for a max profit, so we cleared 517.50. Hey, what you got to understand is I put this trade on every week in my real account. Just this one trade, I'm trying to get 2% out of my total account. So just so you can do some math, for every $21,000 in buying power that you commit to this strategy on a weekly basis, you can usually pull out anywhere from 450 to about, I'll say higher IV, 675 or so. So that's the range we're looking for. And like I said, I've only had one trade that's gone wrong all year long, and all the others have expired for max profits. So that's the name of that game. The most consistent strategy that I've ever seen is this weekly S&P 500 futures thing. It just continues to work in every market. So it's boring, but I kind of like boring. All right, so that's it for the recap. I'm sorry. Let's see what else we have here. Let's go into current trades. So let's take a look at. Okay, this is, nope, we closed that out, so we don't want to take a look at that again. Excuse me just a second. Okay, yeah, this is a snapshot of the trade before it expired for max profit. So that was earlier on today, I think. I think this morning whenever I pulled that off and put the graph in, because I knew it was going to expire for a max profit, and just so we'd have a graph there. But max profit, only one losing trade so far all year long. It's supposed to, yeah, there we go, all year long. All right, let's take a look, see what else we have here. Did I just do that? Okay, this is my Crude strangle in my personal account. We put it on with 44 days to expiration on October 3rd on Monday. Yesterday we were break even, $0. We've been in the trade for 4 days. We're up 500, so we gained $500 today in it. Hey guys, if we get a little pullback in crude next week, theta's going to really come out of this thing. I'm looking to reassess at the 25% profit target level. I want to see where we're at in my P&L graph whenever we get there. So that's the first assessment point. Right now we just hang on, let the theta come out of this baby, and take it off first chance we get. Take a look at the next trade. Alright, this is in my retirement account. It's the broken wing butterfly. That's the only thing I have going right now. This is just a very stable strategy to put in your retirement accounts. So it's going to be a mechanical entry for me every expiration cycle. The day after, I just put one of these babies on. So that's the name of that game, and we'll see how we do with these things over the course of a couple of years. All right, so we put it on with 58 days to go in the SPX. 49 days, spinning it for 9 days. This thing says if we're above 931, take it off. Hey, this thing's not going to move as fast for us right now as our Strangles and our Condors. We went further out, so we got to give this thing time. I mean, you can't even tell it's in the account when the S&P's wiggling around a little bit. There's just no drawdown, no high spikes or anything. We're up a whopping $85 right now, but hey, this thing's doing exactly what it's supposed to do for us. Alright, what else do we have going on here? I think this is the last one. Oh yeah, this is our double your portfolio strategy. So this is the Iron Condor in Crude. Again, this is the strategy where we are intentionally trying to double our money in 12-month period. I don't know if we put this thing on with 22 days to go. We've got 10 days left in the trade. I don't know if you remember yesterday when I briefed you on this thing. We were down $2,700 in this trade yesterday, and I told you I wasn't worried about it at all. We still had plenty of tools, plenty of courses of action and things to do in case it ran up closer to our short strike. Crude had rallied sharply in about 7 days, just a huge rally. So we got a little two-sided action today. We got to drift back. And honestly, if this thing goes back more, I mean, this is just going to be a home run trade for us in our double your portfolio strategy. Hopefully, some of you are getting these trades on with me whenever I put them on, because they are just working like gangbusters, working like they're supposed to. All right, let's see what else we have here. We need to review our weekly levels to see how our levels. Yeah, here we go. That's really not what I wanted right there. I actually wanted let me go over here and open this up, guys. Give me just a second. Okay, let's switch this to, there we go, PowerPoint. Good. Alright, so these are our weekly levels. You guys know I publish these Monday morning. You know, I get up early. 6 o'clock I start working on the levels, get them finished about 6:30, put them out to you guys, put on my weekly Strangles, Iron Condors if I need to, and let them go. So S&P stayed within both upper and lower areas without any issue. And over here I made the comment, maybe you guys are getting tired of me saying that you know, this market never goes down. It hardly ever wiggles. But, you know, honestly, our Strangle program absolutely loves this kind of market. So it's fire and forget in that program. All right, for the bonds. Hey, we had a pretty good move in bonds. Bonds are continuously the most volatile instrument that we follow. All I have to do is look at how many times the bonds pierce the first and second level compared to the other markets that we look at. And bonds by far are the most volatile instruments. So here we pierced the first level, we went right down, kissed the second level, and rallied back. So our second level's held. That's what they're supposed to do. It's a low probability occurrence that they move outside of those second levels right there. All right, let's take a look at Crude. Crude, like I said, rallied strong last 7 days or so. Went right up to our first level on the upside and retreated. So those levels are pretty important. They're nice little areas to trade off of. And let's see, that's not how you spell. There we go. Get my spellings right. Okay, the dollar. Dollar finally moved. It had been in a really tight range for quite some time. You can see there. So she broke out pretty good. Went right up to our second level, and again, what did it do? It retreated. So that's a common theme that you'll see in these markets and these levels that we plot every week. That's why we sell options against them in the S&Ps. All right, here's gold. Now this is a really interesting, very interesting movement right here. Great case study, and really sends home the way that we hedge in these types of trades when we're in them. You know, we would not have gotten hurt in this trade at all. Don't know that we would have come out at a profit, but we would not have gotten hurt in this trade. And that's all we want to do in our hedging program whenever we're in these trades. What we want to do is make sure that these weekly strangles, that we can survive and put them on again for the next week, because we know with decades worth of back testing that over 90% of the time these strangles are they expire for max profit. So we have to be ready for the time like when gold made its move this week. And our first hedging spot are the red stripes. You know, I talk in my classes a lot more about, and I'll delve into it a lot deeper about how I hedge at this point and at this point. So this one, I know guys, you know, you heard me say many times before, 80% of the time, the minute you put the hedge on, it immediately bounces and goes back against you the other way. Well, this is one of the times it didn't, and had you not put a hedge on, you would have been hurt pretty good in a weekly strangle in the gold market. But if we hedge the way that we're supposed to hedge, the way we teach how to hedge, then I'm telling you, as bad as this looks, wouldn't even have been a flesh wound for you. Again, wouldn't have made any money on it, but you certainly would not have lost a lot of money either. And that's what the hedging program is all about. All right, let's take a look at TLT. If we ever get back up into these areas right here, this is where we definitely want to add to our puts. We're betting on bond prices or interest rates going up and bond prices falling. So we're buying puts in TLT. You know, we started buying puts on the rally up right here. So we were all over it. You see my comment, where are the bond kings now? You know, the Gunlock, the PIMCO boys. Yeah, where are those guys at right now? So I would be very, very nervous if I was long bonds and looked at this picture right here, this graph. Could be the low of mankind right there in interest rates. We're up. I wouldn't expect these rates to go straight up. Looks like we've probably got a nice little channel to operate in for a while. So it wouldn't surprise me at all if we saw some downward movement in here. I've got nothing to base that on. That's just my opinion. Absolutely nothing, no models or anything like that. It's just looking at the movement. So, you know, seeing this thing wiggle around a little bit, the interest rates, and then filter back down is within reason. So, yeah, this is the 30-year interest rate. Currently, it's at 2.468. But yes, I would be very worried if I were long bonds right now. So, hey, you might not want to listen to the bond kings because they're buyers of bonds. All right, what else do we have to talk about? Oh yeah, let's just recap the one last thing. Here are the stats for the weekly levels. So we covered the weekly levels. I show you a graph of that. I show you when I plot them on Mondays. I send that out to you. Oh, wait a minute. There we go. So these are weekly stats. It's just a historical archive and data collection that I use to let me know how many times the market's closed beyond our levels in real-time trading. So I've got a lot of, you know, decades worth of back testing that show me that, but I follow these in real time as well. So just to make sure that real-time trading matches back time calculations. And so far it's just as good, if not better, than historical backtesting. So what we see here is the percentage for how often these underlyings closed inside of a specified range for the week. That's what I want to know. The S&P 500 has been very tame over the last 13 weeks, and it's closed inside of the first level 92% of the time. I've lost a lot of money by just not selling against those first levels right there. Yeah, it's twice the amount of theta, the premium that you can collect at that level right there versus at these levels. But you can see it's closed inside of the second level 92% of the time. The bonds, they're very volatile around that first level, very tame around the second level. Crude, very not quite as volatile as bonds, but still you can. It's definitely in a league with the bonds. And honestly, these stats right here are not out of line. The bond move is a little bit out of the ordinary, but I expect over 1,000 trades it should normalize. That's what the statistics tell us. So 69% of the time, excuse me, crude market closes inside of its the first levels that I plot each Monday. 100% of the time over the last 13 weeks, crude is closed inside of the second levels. The dollar, you can see there the levels, and there's the gold. So that's it. Let's see what we've got. New trades. That's probably what we need to talk about. Just briefly get ourselves ready for next week. I think markets are closed on Monday. I have to check and see, but I believe they're closed on Monday. And what we need to be ready for is we need to be ready for Tuesday morning. So, well, let me take that back. Even if the markets are closed, equity markets, the futures markets will be open on Monday. So my intentions are to put the strangles on Monday, and hopefully we'll be able to get some trades on in the retirement account on Tuesday. We'll monitor crude very closely and see how the crude trade works. I might end up putting another strangle on in crude over top of what I have and just keeping those trades going. So that's a wrap for the weekly wrap up, and have a good weekend, guys. Talk to you later.